All right, welcome back to Talk Tickers. Today we're diving into the numbers and the strategy behind Academy Sports and Outdoors, ticker symbol ASO. They had their fourth quarter 2024 earnings call just recently on March 20th, 2025. And we're here to break down what really matters for you as seasoned investors.
Yeah, I think it was interesting. Academy finished out the year with, some decent momentum. Mm-hmm. Especially when you consider that they were dealing with an extra week in last year's fourth quarter, right? So they had that comparison to deal with. Plus, the whole consumer landscape during the holidays was, a little bit shaky.
Right. Everyone was holding their breath a little bit. I mean, the stock dipped a bit initially, right, when the news first came out. But I think you're right. If you really dig a little deeper, there's a lot of interesting stuff happening there.
Yeah, they're definitely making moves to try and grow the business strategically.
For sure. Okay, so let's start with the basics. What did their sales look like? What were the big numbers that jumped out at you?
Well, their net sales for the fourth quarter came in at $1.68 billion. But we have to remember that extra week last year, which definitely makes the comparison a little tricky.
Right. Apples to oranges almost.
Yeah. When you adjust for that extra week, their sales were basically flat compared to the year before. But when you look at comparable store sales, specifically excluding any contributions from new stores, they did see a dip of about 3%.
Okay, that's a pretty important distinction, right? Because that 3% is really telling you about the performance of their existing stores, not the overall growth from new locations.
Exactly. And what I found interesting is that even with that dip, they actually exceeded what they had predicted for both their net sales and their adjusted earnings per share. And their performance in Q4 was actually better than earlier in the year.
So an improvement. Even with all the holiday headwinds and the economic, uncertainty that was swirling around. So something must be working with their strategy, right?
Yeah, definitely something to keep an eye on. It could be their merchandising strategies are gaining traction, or maybe they're performing particularly well in specific regions. It'll be interesting to see if this upward trend continues and what exactly is driving it.
Makes sense. Now, what about their profitability? Did they manage to maintain healthy margin?
So their gross margin for the quarter came in at 32.2%. That represents a decrease of 110 basis points from the previous year.
Okay, so basis points, just for our listeners who might not be as familiar, those are basically hundredths of a percentage point.
Right. So in this case, a decrease of 110 basis points translates to a 1.1 percentage point drop in their gross margin. However, when you compare those margins on that adjusted 13-week basis, their merchandise margins actually saw a tiny bump up about 10 basis points.
Interesting. So a bit of a mixed bag there. What's the story behind that discrepancy? What factors were at play?
Well, a couple of key things were happening. First, a larger portion of their sales were coming from hard lines. That category tends to operate on thinner margins compared to apparel or footwear.
Right, the razor-thin margins in electronics, that kind of thing.
Exactly. And then they also made a strategic decision to implement some markdowns on their apparel towards the end of the quarter. They're basically clearing out inventory to get ready for their spring collections and, importantly, for the launch of the Jordan brand. So they're taking a bit of a hit in the short term to make sure they have a clean slate for these new offerings.
Makes sense. It's like they're prioritizing long-term gains over squeezing every last penny out of the current quarter.
Exactly. Strategic inventory management is crucial, especially in retail, and it looks like they're taking a proactive approach.
Okay, so bottom line for investors, what were their earnings per share looking like?
Their adjusted diluted earnings per share for the fourth quarter were $1.96. So even with the pressures on their margins from that shift in their product mix and the strategic markdowns, they managed to beat their own projections for profitability.
So a good sign there. And what I'm really curious about is how their different product categories are stacking up. I mean, we talked about those hardline margins, but where are they seeing strength? Where are they seeing weakness?
Yeah. So their outdoor category really stood out as their top performer. They had a 2% increase in net sales there. And a lot of that growth came from, those core outdoor activities, hunting, fishing, and camping. Brands like Yeti and Stanley, those premium brands did really well, especially probably with holiday gifting.
Right. Those are definitely popular gift items.
And then, their own in-house brands like Monarch and Redfield, which are more value-oriented, also saw strong sales.
So that value proposition seems to be resonating with shoppers. It's interesting how those two ends of the spectrum, the premium brands and then the value-oriented options, are both performing well for them.
Yeah, it's a good balance. And then apparel, they did have those markdowns, but still their apparel sales were only down by 1%. And importantly, during the holidays, They saw a real rebound. Youth apparel, fleece, and workwear, those were strong categories for them. And brands like Nike and Carhartt, those are powerhouses that definitely contributed to those positive results.
Okay, so a little bit of a dip earlier in the quarter, but they managed to capture some of that holiday demand. And what about sports and recreation? I feel like that's such a broad category, everything from basketballs to bicycles.
It is. And they did see some improvement in that segment. Sales were down just 1%. Their promotions in categories like kids' bikes, grills, and those ride-on toys, those seem to be pretty successful. And they also saw some positive momentum in their fitness business, which they attributed to their focus on offering lower price items that are popular as gifts.
So those smaller ticket items, maybe impulse buys, things that people are grabbing for stocking stuffers or as add-ons to bigger purchases.
Yeah, exactly. And then footwear, that category was down 2%. But within that, they had some bright spots. Men's athletic and work footwear were both performing well. And specific brands like ASICS, New Balance, and Crocs, those all had a good holiday season.
So even within a category that was overall a little bit down, there are still pockets of strength. And I think it's worth highlighting their private brands again. We talked about it with their outdoor category, but it sounds like those private brands are playing a big role across the board.
They really are. Across all their divisions, their private brands saw significant growth. And now they make up 23% of their total net sales for the full year.
Wow, that's a pretty significant chunk of their business. It really highlights how important that value proposition is to their customers.
It really does.
Okay, so let's shift gears a little bit and talk about growth. They're clearly focused on expanding their footprint, right? How many new stores did they open this past year?
They opened 16 new stores in 2024. That expands their reach to 19 states. What's particularly interesting, though, is that the stores they opened in the later part of the year, using that refined site selection model, those are actually performing better than expected.
Oh, so they're getting smarter about where they're putting their stores.
It seems that way. Like their store in Meridian, Mississippi, which is in a smaller market with less competition, that one's significantly exceeding their plan, capturing a pretty large share, of 25% of the local sports and outdoor business.
That's impressive. And it's also interesting because it suggests that they might not need to go after those really competitive, expensive urban markets to find growth. Maybe there's a lot of opportunity in these smaller, underserved areas.
Exactly. It's a different kind of growth strategy, potentially less risky, and investors should definitely be paying attention to how these stores perform because it could be a real sign of what's to come.
Makes sense. What about those stores that they opened in 2022? How are those doing? Those are now mature enough to be included in those comparable sales figures, right?
Right. And those stores are also showing positive comparable sales, outperforming the older, more established stores. So it's not just about adding stores, it's about adding stores that are actually driving meaningful growth.
Okay, so they're hitting their stride with this new store strategy. And looking ahead to 2025, they're planning to keep their foot on the gas, right? What are their plans for expansion?
Yeah, they're planning to open between 20 and 25 new stores in 2025. They're going to be a little more balanced in their approach this time, spreading those openings throughout the year and across different regions. They mentioned to focus on suburban and mid-sized markets, and they've already opened 3 stores in Pennsylvania and Maryland.
So continuing that expansion, but maybe with a bit more finesse, a bit more targeting, rather than just, blanket coverage.
Exactly. Refinement is the key word here. And of course, we can't talk about growth without talking about their e-commerce efforts. I mean, that's a must-have for any retailer these days.
Absolutely. So how's their online presence looking? What are their plans there?
Well, their e-commerce penetration held steady at 11% in 2024. But they're definitely making moves to improve their online experience for 2025. They've got a 3-pronged approach: improving the fundamentals of their website, offering a much wider selection of products online, and enhancing those fulfillment options like same-day delivery.
Sounds comprehensive. And what do they mean by improving the fundamentals of their website?
Well, things like making their search function more intuitive and user-friendly, streamlining the navigation, especially on mobile devices, basically making it easier and faster for customers to find what they want.
Yeah, those seemingly small things can make a huge difference in the online shopping experience. And I think it's smart that they're focusing on expanding their online selection, particularly in those categories that might be harder to find in store, like firearms or, very specific types of footwear.
Right. It opens up their market to people who maybe don't have an Academy store nearby or who prefer the convenience of online shopping.
Absolutely. Now, beyond opening new stores and boosting their online presence, what are they doing to get more out of their existing brick and mortar locations? How are they making those stores work harder for them?
One of their big focuses is on bringing new and exciting products into the stores faster. And the biggest initiative on that front is their launch of the Jordan brand. They're rolling that out in 145 stores and online in late April 2025.
The Jordan brand. That's huge. I mean, that's going to be a big draw for customers.
They're really going all in on this. It's the largest brand launch in their company history. They're going to have dedicated Jordan shops within those stores, featuring a mix of men's, women's, and kids' apparel and footwear. And they're specifically aiming to reach those underserved markets that maybe haven't had easy access to Jordan products in the past.
So it's not just about bringing in a big name brand. It's about using that brand to strategically reach new customers.
Exactly. They're also expanding their partnership with Nike, broadening their selection of both lifestyle and performance running shoes and fashion apparel.
So more Nike, more Jordan, and to make room for all that, they're cutting back on some of the underperforming brands and categories.
Exactly. They got to make space for the new stuff. And they're also adding a few other interesting brands to the mix. They mentioned Converse, Osprey. They're expanding the presence of brands like Burlebo, Ariat, Birkenstock, Waggle, and Ninja.
Okay, so a real refresh of their in-store offerings, trying to appeal to a wider range of shoppers. And I think this all ties back to their emphasis on value. It's something we've touched on throughout this deep dive, but it's clearly central to their strategy. How are they managing to maintain that value proposition in the face of, rising costs and inflation?
They're really digging their heels in as a value leader. They're planning to hold prices steady on their key high-traffic items, even with those tariff increases on imports. And they're using those price optimization tools to make sure they're staying competitive. And of course, they're continuing to grow their private brands, including an expansion of their Brazos workwear line and the launch of an exclusive Jacob Wheeler collection within their Magellan Outdoors brand.
Right. Private brands give them more control over their pricing and can be a real differentiator for them. And what about customer engagement? How are they building loyalty and fostering those relationships with their shoppers?
Customer engagement is a big part of their plan. Their My Academy loyalty program added over 11 million members in 2024. And they saw a lot of engagement from those members, especially during the holiday season. They've also got a customer data platform that's almost doubled the size of their addressable customer file, which means they can do more targeted and effective marketing. And they've brought on a new advertising agency, McGarrett Jesse, to help boost their brand awareness and resonance with an initial focus on that Jordan launch.
So using data to reach the right customers with the right message, that's smart marketing. Now let's talk about the operational side. Are they investing in technology to improve efficiency and streamline things behind the scenes?
They are. They're rolling out RFID handheld scanners to all their stores in the first half of 2025. They're expecting those to boost inventory accuracy by 20% to 25%. They're also giving their store associates new handheld devices with integrated point-of-sale functionality. And they've already implemented a new warehouse management system to increase productivity in their supply chain.
So those behind-the-scenes improvements that can really add up in terms of cost savings and a better customer experience.
Exactly.
All right, so we talked about sales, profitability, growth strategies, and operational improvements. Let's wrap up with a look at their financial health and how they're rewarding their shareholders.
So in 2024, they generated $528 million in cash flow from operations and $342 million in adjusted free cash flow. They plowed about $140 million back into the business for those growth initiatives we talked about, and they returned over $396 million to shareholders through dividends and share repurchases.
So a good mix of reinvestment and rewards for shareholders.
Yeah, they're striking a balance. And the board just approved an 18% increase in the quarterly dividend, which will be paid out on April 17th, 2025. And they've still got $566 million left on their share repurchase authorization.
That dividend increase is a nice bonus for investors, and those share buybacks can be a good way for the company to boost their earnings per share and return value to shareholders.
For sure.
Okay, last but not least, what are they expecting for the year ahead? What guidance did they give for 2025?
So they're projecting net sales to be somewhere between $6.1 billion and $6.3 billion, with comparable sales expected to range from a 2% dip to 1% gain. They're forecasting a gross margin rate of 34% to 34.5%. Taking into account those tariffs. They think they've largely mitigated those tariff risks by diversifying where they get their products. Their exposure to China is under 9% and getting smaller. They expect GAAP net income to come in between $375 million and $410 million, and adjusted net income between $400 million and $435 million. Adjusted free cash flow is projected to be between $290 million and $320 million, with capital expenditures in the $220 million to $250 million range.
Okay, so a pretty solid outlook overall. Any interesting quirks or things that stood out in their guidance?
Yeah, they're expecting the first quarter of 2025 to be their toughest, but they see things picking up in the second quarter as those growth initiatives start to gain traction. And they specifically called out the strength of their upper income consumer demographic as a positive factor. So it seems like even though they're a value retailer, they're attracting shoppers across a range of income levels.
Fascinating. Okay, well, I think we've covered a lot of ground here. Really appreciate you breaking it all down. Now, before we wrap up, let's get to our "This is not financial advice" segment, but it's fun to think about. Based on what we've discussed today, what's an outrageous but maybe plausible trade idea that comes to mind?
Okay, so how about this? Go long on Academy Sports and Outdoors, ASO, and simultaneously short a basket of those traditional athletic footwear and apparel retailers. The idea here is that Academy's approach to this Jordan brand launch is different. They're not just chasing those limited edition releases in that hype-driven market. They're going after a broader base of consumers with more of a focus on sports and accessibility. And if you combine that with their already strong value proposition, which seems to be resonating even with higher income shoppers, they could be poised to steal some serious market share from those incumbents who are heavily reliant on those exclusive drops and a less price-sensitive customer.
So you're basically betting that Academy, this value player, can shake up a segment that's traditionally been all about premium brands and hype.
Yeah, exactly. It's a contrarian play, but it's based on some real trends that we're seeing.
It's definitely food for thought. As always, this is not financial advice. All right, so that was your rapid-fire deep dive into the Academy Sports and Outdoors earnings call. We've hit the key metrics and the big picture strategy. What stood out to you? Do you think this Jordan launch is going to be as impactful as they're hoping? Let us know your thoughts. Keep the conversation going. This has been Talk Tickers, your shortcut to understanding those crucial earnings calls. We'll catch you next time.